Thanks, everybody, for joining us. Usually, in such an event, we would spend time talking about our long-term view on the role of oil and natural gas and speak to drivers of demand, et cetera. But I think given what has been going on in the energy market year-to-date, at least with the Trump election, there are a few more pertinent and timely themes that we should spend our time on. And so our views remain consistent. If anybody that's followed our work for a long time, we think that the demand for oil, natural gas, coal, all hydrocarbons is going to grow for longer and stronger. The main drivers of that are, of course, population growth, rising living standards, and urbanization. There's no shortage of material that we've put out. But we wanted to address a few things specifically on oil and natural gas in what is going to be, I hope, a punch-eater version. I'm going to target speaking for 25 minutes or less. And we want to reiterate some of our main themes. We view the current macro for oil and natural gas to be very, very bullish, and yet there is a divergence between what we see and what we believe and what consensus believes. And we think there's a few key reasons for that. And so we want to direct those head on. And our outcome is for you to leave this 25-minute conversation either feeling meaningfully more optimistic about what you own, or hopefully being able to see the opportunity that we see in energy stocks, especially Canadian energy stocks, which are at a material discount. There's a few reasons for that discount. We've had a political risk discount applied to our stocks with a 9.5-year government that has not been the biggest proponent of the space. We've had to deal with such things as carbon taxes and emissions caps and canceled pipelines, et cetera. But currently, very clearly, the concern that people have is tariffs. With Trump getting elected with his promise of a 10% tariff, the 30-day extension, is it a negotiating tactic? Is it not? Does he want us to become the 51st state, et cetera? There is so much uncertainty, and we can see it on a daily basis. It is paralyzing people to either be able to commit capital, to deploy capital, or keep capital deployed for that matter. And so we wanted to speak to and reiterate our view that even if Canada is subject to tariffs in 2 weeks, 3 weeks, whatever the time frame is, that oil will be exempted. And if oil is not exempted, why do we think that the tariffs would be very short-term in nature? And it comes down to, it is one of the only products where Canada actually has power in the negotiation. Very few other areas. Oil, it does. We account for about 63% of U.S. imports, specifically in PADD 2, the Chicago area, where they import in 3 million barrels per day via pipeline of Canadian oil. Their refineries, not just in PADD 2, but almost all their refineries are suited, they're geared to literally process Canadian heavy oil. And specifically that 3 million barrels per day that they import into the Chicago area via pipeline, there's no alternative. You can't barge, you can't truck 3 million barrels per day. And so a tariff would be, in that instance, we think, a direct pass-through to the U.S. consumer. 10% would mean about a 15-cent uplift per gallon of gasoline. 25 that was originally floated, that was going to be about 40 cents. And so at a time when Trump's primary mission is to drive inflation down, it doesn't seem logical and conducive that he would give an immediate cost pass-through in the most visible cost of living, which is gasoline. If we're wrong, if a 10% tariff does come onto Canadian oil and gas companies, we've modeled it out with the most amount of precision possible. It's a little more challenging with the integrated. You've got to make too many assumptions where you kind of lose confidence in your numbers. But for the average name that you see on your screen, we're talking about a 7% hit to cash flow. 7. Very, very manageable. At the same time, Canadian energy stocks have meaningfully underperformed their U.S. peers. And so we think valuations were already, and now we're most certainly discounting tariffs coming online. It's interesting, as of this morning, you would expect the differential for Canadian heavy oil, and light for that matter, but for Canadian heavy oil, we think will blow out to about $17 to $18. This morning, it's trading at 13. And so that's reflecting a market that also does not believe in the likelihood of tariffs. But we see this as the most immediate near-term concern that people have for Canadian energy stocks. The second we addressed was the political risk discount. It's still our belief that we'll have an election in May. Polls would suggest still a clear conservative majority, the policies of which we think would be much, much more supportive of the space, most especially the build-out of new pipelines. We'll address this later on, and we've received a lot of questions. We came out of writing retirement for the National Post last week to address something we felt important enough to try to put pen to paper with. We wrote a column that was very well received, speaking to the necessity of building out pipeline capacity both on the West Coast and East Coast. And you can actually feel a national conversation starting. We actually even had the Premier of Quebec, who has been opposed to oil pipelines, actually say, maybe not today, but he sees the possibility of there being a moral imperative, or whatever term he used. And so that was a softening in Quebec's anti-pipeline stance going back many, many, many years. And so we remain optimistic over the next, let's call it, a couple of months. Hopefully we get clarity on tariffs. We remove that risk. We then also get an election, which we believe will eliminate the political risk discount in our stocks. And so those are two near-term catalysts that we see. When we look at then the setup for the energy market now, for those who follow our work on Twitter, one of our favorite measurements of the health of the market is global oil inventories. It is the nexus of supply and demand. If inventories are falling, that historically at least has been a very bullish signal. It implies an undersupplied market. It's interesting that at a time when global inventories typically build, Q1 is seasonally the weakest period of demand, and you'll see on the left-hand side, inventories typically build. Well, we've actually lost about 55 to 60 million barrels since the beginning of the year. It's interesting, one of our consultants, Rystad, we were pulling it up this morning in preparation, they're still calling for 1.5 million barrel per day rise in inventories. Well, we're drawing. And so it's actually tighter by about 2 million barrels per day than what they thought. And so the market is tighter. And so we need to reflect on what are the driving factors to that. And secondly, more importantly, why is the market just simply refusing to acknowledge this? Why are oil participants refusing to acknowledge what is literally right before your eyes? And that is a market that is very tight. So let's explain, okay, what are the drivers to that and why are people ignoring it? There are three main drivers for why the market is meaningfully tighter than what people believe, and why on the right-hand side we show, going back to at least 2017, I think, the deficit relative to average levels continues to hit record lows or record highs. Very bullish as well. The main drivers have been, in 2024, the main narrative around demand was China, a weak China. We know that Chinese demand was very, very disappointing. For many months last year, it was actually negative year over year. There are some indications that Chinese demand is starting to improve. Setting that aside, global oil demand, so global to global commodity, remains pretty decent. We had another friend of ours, Mike Rothman of Cornerstone, saying that for the month of January, he thinks demand on a year-over-year basis is up about 2 million barrels per day. Very, very healthy. The second driver for the tightness in the oil market has to do with U.S. shale. We know, and we'll spend some time on this because it is a massively important concept to wrap one's head around, because it's very counter to the narrative, the negative narrative that you hear on a daily basis with drill, baby, drill, et cetera. U.S. shale last year grew at its slowest pace, or one of the slowest paces, since it began, going back to the mid-2010s, 2014, give or take. And so why is that? We'll address that later on. Thirdly, what we've seen is ongoing cohesion within OPEC is very, very strong. Compliance on the part of some of the countries that failed to abide to their deal in 2024 have meaningfully improved their compliance. There were some headlines on Russia just recently. And so those three factors of demand being stronger than consensus believes, U.S. shale disappointing meaningfully, and thirdly, this combination of non-OPEC supply / OPEC removing barrels has led to where we stand today. I've got a chart later on that would show that oil today is at roughly $15 mispriced. It's too cheap by $15. And so why is that? We think the market has been lulled into a false narrative. And that narrative now is President Trump, drill, baby, drill. Supposedly the Democrats were, blocking meaningful growth through their anti-oil rhetoric, non-permitting and not access to land, et cetera. And Trump is going to magically pick up the phone, call all these oil CEOs, and they're all going to rise to the rally call and significantly raise their production. We watch CNBC on occasion. Every day that we do, we see a generalist fund manager getting on and get asked about energy, and they say, well, we don't like energy because we see a surge in production coming after the Trump presidency and such. One of my highest conviction calls is that the drill, baby, drill mantra is entirely toothless. And if you spend 30 seconds considering it, I think you would arrive at that conclusion as well. I mentioned earlier, U.S. shale is growing at one of its slowest paces in history. Why is that? One of the reasons is the era of meaningful growth of prior generation of shale was driven by massively outspending your cash flow. in fact, free cash flow. That term didn't exist. Today, the absolute contract that oil companies have with their shareholders, i.e. the owners of their business, is to adopt a strategy of low to no growth, maximum free cash flow, and use that free cash flow for either variable dividends or increasingly share buybacks. And so there's meaningfully less capital to invest. The other aspect that we see, and we've got a couple graphs to demonstrate this, is very clearly well productivity are getting poorer. For the same amount of rock that you were drilling, you were getting less and less oil from that well. So the average productivity has fallen. And at the same time, something called the gas to oil ratio, the amount of gas that you're getting from that oil well, because typically on all oil wells, you get some semblance of gas. Well, the amount of gas relative to oil has been increasing over the past couple of years. And that is the biggest telltale sign of maturity of the basin. And so what we see is, this isn't a hope, this is not a forecast anymore, this is reality. Growth out of U.S. shale has already massively slowed down. And the reason why this is so unbelievably important is if you think about the past 10 years, non-OPEC supply over that 10-year period grew by 5 million barrels per day. So non-OPEC supply that includes U.S., Canada, Brazil, obviously shale. U.S. shale over that same time frame grew by 6 million barrels per day. And so U.S. shale has been more than 100% of all of non-OPEC supply over that past 10-year period. And so when you're now losing growth from that marginal source of supply, where the world would have been an energy supply crisis were it not for the rise of U.S. shale, and now we're losing that source of supply, and the data is right before your eyes. And so we believe, and we're referencing energy aspects, corroborating our view. There are some others. We put up Sanford Bernstein that just came out with an updated piece over the weekend. We put that up on Twitter, all speaking to how U.S. production is in a plateau at a very low level and ultimately declines, because you have growth from the Permian, yes, but you have declines in most other basins. And so when you look on the right-hand side, Energy Aspects has the Eagle Ford in decline, the Bakken, that's Williston, going to decline next year, and even Permian growth starting to meaningfully decelerate. So net-net, they would have modest growth. So we're not talking about declines yet, but very, very modest growth coming out of U.S. shale. And so we have analysts saying that. We have oil companies saying that. We have service companies saying that. We've put up direct quotes on Twitter talking about everything from the Weatherfords to, I think we referenced Schlumberger, Patterson, so everything from drillers to pressure pumpers, et cetera, all saying that they see flat to down activity this year over last. We even have the U.S. government saying it. This is directly from a January 2025 report from the EIA. And what I would focus you on is on the right-hand side, that yellow line showing a expected, that you're looking at that bar, meaningful loss of meaningful supply growth. And so 100,000 barrels per day, 200,000 barrels per day in the context of 1.2, 1.3 million barrels per day of demand, you've now lost meaningful growth, not just from shale, but because shale has been such a massive component of non-OPEC supply, we're now in a point where we see peak growth from non-OPEC this year, and that number falling forever, ultimately getting to a point where, give or take 2028, and it's kind of one of these, but it's really the trend, it's not the absolute number, where you will no longer have any growth from non-OPEC. This has a massively, massively important implication for the oil market and for sentiment, because why is oil so mispriced? Why does oil trade $15 below what we think fair value is using days of supply? And I'll back that up in a moment. It's because of this false narrative that U.S. shale is growing, it's surging, drill baby drill. These CEOs are going to ignore the demands of their owners, their shareholders, and for some reason surge production, crash the oil price, and why, again, you see quickly why there's no logic behind that. And so that is a very high conviction call. It then means that not just is shale slowing down, but non-OPEC supply growth is meaningfully slowing down in a world where we see demand growing, of oil demand growing for at least the next 10 years. And so there is a growing call on OPEC, which is very, very important because the final reason, there's two, these false narratives. One is U.S. shale production surge. The second is, well, it doesn't really matter because OPEC Plus has all of this spare capacity. You know, I've seen numbers as high as 12 million barrels per day from a broadcaster on a Canadian business channel. We think the real number is 4 million. in what is now 104.5 million barrel per day market. Historically, that's pretty small. And it's not even the number that matters as much, it's who holds that spare capacity. Almost all of it is basically held by two countries, Saudi Arabia and the UAE. And so you need to interpret what, through their actions, through their messaging, what do you think, and they never speak about price, but one would imagine at least that there's a price in everyone's mind in terms of what is that fair price, both for the consumer and both for the producer. When you acknowledge the amazing vision that the Saudi government has to grow their economy, to expand their economy, to leverage hydrocarbons, to allow them to do that, to reduce their long-term dependence on oil, where I think oil is roughly now 65% of their GDP, and going after things like tourism and sports, et cetera, massively expensive. And so we think that the ability of Saudi Arabia and OPEC to play the long game, because a barrel not produced today is a barrel produced tomorrow at what I think will be a meaningfully higher oil price. Because if non-OPEC has the inability to supply the market going forward, we showed you math to arrive at that conclusion, then OPEC is really in the driver's seat. And so what is that fair price that is fair for the consumer and the producer? What is that oil price that allows industry to actually invest sufficiently, once again, to allow production growth in 5, 7, 8, 9 years, which is long cycle time? We think that oil price is meaningfully higher than where we trade today. And so that's one of the distinctions I would leave you with. The market is too focused on the absolute number, which in and of itself remains low relative to demand. The key distinction is who holds it and what are they trying to achieve. And so we really do not think that spare capacity held by OPEC is a major encumbrance. And what we show here is, assuming OPEC follows through on their plan to gradually, slowly, methodically, being preemptive, proactive, and precautionary, and returning those barrels to the market, even if they go ahead beginning in April, the blue line is inventory builds, and then the top is the 5-year average. We do not think that OPEC wants to reduce the deficit relative to that 5-year average number, and we show you that even if they go ahead, inventories are still in very, very healthily low levels. The last thing that the market is completely ignoring in a bear market, they tend to do this, is, of course, let's ignore any bullish potentials. It's the maximum pressure campaign that Trump has announced that he will be enacting. We see the ability to impact 500,000 barrels to 1 million barrels per day of exports, primarily heading to China. With the state-owned refiners versus the teapots, we think the U.S. Treasury, should they so choose, has the ability to meaningfully lower their production levels. At the same time, we've had sanctions announced by Biden in coordination, we think, with what was then the incoming Trump administration, that also has the ability to impact Russian volumes. So net between the two, we're talking potentially removing 1 million barrels per day or more, should they so choose, with sanctions that have proven to be effective, as we demonstrate here when Trump enacted them in the first place. But the market is completely ignoring that. And so we see a market where global oil inventories are at their lowest levels in history. Demand is at its highest point in history. U.S. shale, the biggest source of marginal supply over the past decade, is now in its twilight. That rate of growth is massively slowing down for reasons that are both financial and, more importantly, geological. And we do not see that improving. And that we therefore see, especially beginning in 2026 and beyond, a meaningful and growing call on OPEC, where they will at some point return those barrels to the market at a time and price of their choosing, because they are increasingly in the driver's seat. And so this is the reason why we are supported by the belief that oil today, relative to days of supply, is mispriced by about $15. We're trading roughly 72, 73, when fair value is going to be closer to 90. So that's not a forecast. We still think that oil is going to trade at roughly a $70 to $80 band. We'll show you what energy stocks look like in that environment. But it certainly feels like $70 is a pretty good floor for our stocks, and that's our base assumption in a lot of our valuation work that we do. We've also been increasingly bullish on natural gas beginning about mid-2024. The challenges with gas have always been weather. Past 2 years, winters have not been cooperative, more so in the U.S. than in Canada. But the United States has built out LNG, liquefied natural gas, as a new source of demand That's been pulling on inventories, helping to negate any weather impacts. At the same time, U.S. producers have shown a lot of discipline. So when gas prices are low, they actually stop drilling. What a concept. They actually start curtailing volumes. And as a result, what we show on the left is inventories are below the 5-year average. Flip to Canada, we're not quite so lucky. We have producers which, for reasons that we can't quite understand despite ours and others' best interests, continue to add volumes on to what is an oversupplied market, growing supply into weak pricing hubs, chasing the dream of LNG, where LNG in Canada, we've got 1.8 BCF a day of demand coming online, hopefully by the end of this year. It's ramping as we speak. But producers have already drilled into that. And so it's not the bullish catalyst that it could have been had we seen more discipline. It's the reason why we vastly prefer to get our natural gas exposure in the United States. We have about a 40% weight to gas, 60% to oil. We either are long condensate producers in Canada with natural gas, or long dry natural gas producers in the United States. I mentioned LNG, huge increase. The U.S. is essentially doubling their demand from roughly 14 to 28 Bs by the end of this year. We've had estimates from TC Energy, the old TransCanada, before they wanted to get the Canada name out of their branding, estimating that the demand for natural gas between now and 2035, so call it 10 years, is going to grow by 40 BCF a day. That's a 33% uplift in demand. It's staggering. And so our view is to raise supply of that quantum. There'll be, you've got Marcellus as kind of pipeline constrained. You've got growing natural gas from the Permian as the gas to oil ratios increase, et cetera. But the biggest call is going to be on the Haynesville. And so the Haynesville is one of the higher cost sources of supply in the United States, requiring a $4 to $5 natural gas price to incentivize drilling and incentivize supply growth. We're trying to be cautious and conservative. We're using $4 in our work as a long-term natural gas price. And so at a $4 price, we can still find very, very compelling natural gas opportunities. And then we're just bullish power as well. We've had this slide in the past. It's just a reminder why this false narrative about some massive energy transition that we're on is complete ignorance. When you look at the increase in power demand, this isn't AI and DeepSeek and all these things. This is just really the build out of data center, power demand, reshoring, population growth, all of these different things where we finally have power demand growing, 25% increase between now and 2040. And just the quantum of increase, we'd have to either more than double the amount of nuclear reactors with build cycles of 10 to 20 years, not possible. Build almost 5 million acres of solar farms, which nobody wants to build right now, really in size. Or we can't even build wind turbines because Trump has made it illegal off the East Coast. They would require 115,000 wind turbines. And so I've always detested the term, it's the bridge fuel, like natural gas is the bridge fuel, because it assumes you're bridging to something when there's nothing at scale and economic to bridge to. Natural gas is the fuel of today and the fuel of the future. So we're very bullish on not just oil, but natural gas. And so let's relate it back to energy stocks. We mentioned that we're using $4. That's at the lower band to stimulate supply growth meaningful from the Haynesville. We think oil will trade at a $70 to $80 band this year, higher than that in 2026. And so we see a sector trading at 11 to 15% free cash flow yield between 70 and 80. So think of free cash flow yield as a potential dividend yield or the amount of stock that companies would be able to buy back. We've been massive proponents of companies adopting meaningful share buybacks over time, just in case sentiment remains weaker than what we see. And I think ours and other efforts have successfully convinced oil companies to adopt this philosophy. So this is one example to demonstrate just how powerful meaningful share buybacks over time. This is a real life example of a company. It's a 10.5% weight in our fund. It's a mid-cap Canadian oil sand company, single asset. It's a very clean story to use. They are adopting a strategy of low to no growth, about a 5% CAGR between now and 2030. So you see that at the top, growing from 100 to roughly 129,000 barrels per day. They have reached their final debt target. And so all of the free cash flow is being returned to shareholders, primarily in the form of buybacks. And so what we would focus you on is the yellow arrow. Over time, this company, over the next 5 years, will have the ability to buy back 64% of their shares, funded out of free cash flow, and drive their free cash flow yield from 12% to 35%. Our view is fair value for the sector begins at about 10%. That's a bit, they call it a 10% dividend yield. That seems reasonable. That would be a tripling in the share price between now and 2030 to go from 35% back to, call it 10. And that's importantly at $70 and a flat oil price, ignoring the exhaustion, the twilight of U.S. shale, the exhaustion of OPEC spare capacity by that time, ongoing demand growth, all of these bullish factors. If you dare to dream for a moment and believe just in 80, which we think with the passage of time will be very, very conservative, this company can effectively almost privatize over 5 years' time. And I know people have been hearing this for the past couple of years, but we're finally at the point where companies are meaningfully buying back their stock. This company just last month, January of 2025, bought back $70 million worth of stock. It was their single largest month of buybacks in their corporate history. And so companies are very much walking their talk. This is proof of that. This is looking at the amount of stock that has been bought back over the past 3 years from 2022. We have companies like a Secure, an Imperial, a Trican that's bought back roughly 25% of their stock. All very good performers. Some of the holdings, this is all publicly available. MEG's bought back 15%, ARC has bought back 15%, Athabasca bought 15%. And what we show on the right is there's a very strong correlation between the amount of share buybacks and share price performance. And so this very much is the philosophy, this is the religion, this is the commitment of the sector. And so even if sentiment remains challenged, even if investors want to go chase NVIDIA or Fartcoin or whatever they're deploying their capital in as opposed to energy stocks, oil and gas companies have the ability to drive a meaningful re-rating over time solely through the meaningful share buybacks funded out of their free cash flow. The macro backdrop for oil and natural gas is unequivocally very bullish. Demand expectations are very, very low, and growth is beating those expectations handily. Global oil inventories are at their lowest levels or near their lowest levels in recorded history. So that's 2017. That's as far back as satellite data goes. But from 2017 until now, that's 8 years. Demand's probably grown by 9 million barrels per day. I'm cuffing that a little. So we're very undersupplied. Oil is mispriced by about $15. And we think the reasons for that is the false narrative of meaningfully growing U.S. shale, surging U.S. shale, drill, baby, drill, et cetera, and that OPEC has all of this massive amounts of spare capacity. The data is in. U.S. shale has meaningfully slowed down. We think under the Trump administration we'll actually bear witness to peak shale over the next several years. And we think OPEC spare capacity is really 4 million barrels per day, which in a 104.5 million barrel per day market is very modest. We believe they will be very cautious, very preemptive, proactive, and precautionary in returning those barrels back to the market, and therefore spare capacity is not the problem that the market sees it to be. Even at the lowest end of what we think that trading range is, we can actively go buy back companies today that can buy back more than half of their shares outstanding over the next 5 years, funded out of free cash flow, and still have decades worth of stay flat inventory available. Natural gas, weather is finally cooperating, inventories are normalizing. We're 40% weighted towards natural gas. We see very, very good opportunities either in dry natural gas producers in the US or condensate liquids rich producers in Canada, where they have the benefit of what oil sand companies have, decades worth of stay flat inventory. And so it remains a sentiment challenged market. We see the maturity, the twilight of U.S. shale being that most near-term catalyst to improve sentiment at a time when hopefully in the next month or so, we can get past the tariff uncertainty and we can eliminate the political risk discount being applied to Canadian energy stocks. And so we remain bullish in the outlook for Canadian energy stocks, especially given how strong balance sheets are. Many have no debt, and if they do, they have very little debt. They have decades worth of stay flat inventory. They're trading at half of historical valuations, and they're using all of that free cash flow to take advantage of the apathy and meaningfully buy back their stock, where our second largest weight in the fund just had their single biggest month buybacks in its history last month. Thank you for your time. Please reach out at any time with any questions that we did not address.